Yo, what's up, everybody? We are back live at it. And I actually didn't know if I was going to do a stream today, but there's a couple things that I do want to talk about. One of the things I got in a feedback form I put out is a couple people were asking for some updates on some of the covered Strangle strategies that I tend to run. So the goal of this session is actually to talk about two of those trades. And then the other thing that I'm actually working on right now, I can show you, is I'm in the process of building a different kind of directional scan based on some different research I've come across. So I want to spend a little, I was messing with this right before I turned this on. So I want to spend some time talking through what I'm trying to do here, so that, again, as per usual, you guys can see a little bit of the method to the madness on what I do and how I do it and why I do it that way. So I guess we can probably start with this first, and then we can talk a little bit about the covered strangles, just because this is already up and running. Let me grab the chat though, move that over here so I can say hello to you guys and follow along with the shit talking. We got Truck and Plane Tom and Trey. Good to see you, boys. All right, so let's start from here. Right now, as I look at the market, I am seeing definitely capitulation. That is without a doubt something that is on my radar. And what I'm talking about with this is, we don't have to look at this. This was random. If we take a look at SPX, and if you were in the Outlier Pro, or if you watched the technical analysis segment that we did yesterday, we talked about some of these very things that you're seeing today, which is the short-term moving averages are kind of flattening out in a pretty meaningful way. Price is actually crossing below the shortest term moving average. And then the 20-day moving average here is definitely petering out, and price is converging on that. That matters to me actually quite a bit, and specifically for these shorter term trades. In terms of breadth, we're seeing definitely an expansion of new lows and net highs lows to the low side. And I'm seeing volatility expanding, specifically even month 2, month 6. These have gone up pretty meaningfully as of late compared to the front month. So all of this is to say, just from a broad breadth perspective, I'm seeing rotation. I'm seeing the market stalling out a little bit here and starting to turn over. And I think there's a few reasons why that's happening. We did get a really, really hot PPI print this past week, and that's not an insignificant thing. That impacts, and that's the last data point that the Fed is going to get, economic data point, before they go into the Fed meeting next week. So we have a couple things coalescing together. Now, as I look at the Fed Watch tool, which I can grab that real quick, and we can take a look at that together, but I don't think there's any significant impact, if I am not mistaken. Yeah, so really no significant impact at all to the 20 March meeting metric. That is about the same. And then as I look out a little bit further though, take a look to June, no change has gone up a lot. So it's gone from no change used to be a week ago at 26%, 27%. A month ago was 18%. Now it's up to 43%. So what I'm starting to see in a pretty meaningful way is stagflation potential. That's a specific economic term. Doesn't fully apply in this scenario, just to be clear. But what I'm really trying to convey is that inflation is being more persistent. And again, we're seeing that. So because of that, and I was looking at some metrics yesterday, eggs from the past year, they're still up over 30%. Dairy is up like 15%, if I'm not mistaken. So there's a lot of areas where inflation is still being felt to a pretty meaningful degree. Okay, all of this boils down to the fact that I'm not ultra bullish at this exact second. That's really the feeder for the conversation. So with all of that going on, that's why this week, and again, for the Outlier pros in the Discord earlier today, I was kind of outlining some of the money movements I'm making. And a lot of it today is, I can tell you exactly what was going on. Specifically in the covered strangle, I've unwound a pretty meaningful portion of my long position. So right now in the covered strangle and IWM, I'm down to like 50% utilized. My basis is now up because I've unwound a lot of my longer term gains. So the basis on this is like 202 on the existing position. So if I grab IWM here, I see a few things. We've come down off this high, started to consolidate here, no problem. Big down day, don't like. Not a gap lower, but an open lower below these moving averages as they're turning over. Don't like that. So all of this is me just being sensitive to price movement. So what I'm doing now is what I was kind of explaining a bit in the Discord. I'm rotating some of my capital from being tied up in long shares, and I'm moving over into not having cash deployed out quite as much. And then I will use short puts to maintain some level of exposure, but I'm not keeping a bunch on here. And then the game plan specifically with IWM is just see how it behaves here. It's still doing okay, but if we look on the year, now it's up 1.51%. The S&P 500 is up 8%. So both of those have slowed down a little bit. And when I look at the chart, at least in the short term here, again, this just doesn't bleed bullish to me. This gives me overall indication that it looks like we could be consolidating a bit here, and that's totally cool. But this isn't a spot that I'm going to hold a ton of inventory. So as I look out through the rest of the trade, I want to see how it behaves around these moving averages. I want to see if it starts to consolidate here. If it does, I'll happily add more exposure. One of the things to keep in mind, specifically as traders, is we are free to enter and exit at will. So with something like this, there's no reason for me to sit there and hold something that's not doing what I would like it to do for an excessive amount of time. But because it's starting to actively not do what I want, that's a problem. I've had a really, really good ride in this product, especially because I had some exposure all the way down sub 100 back from COVID. And I'm now getting to a point where I want to maintain, again, probably about like a 40 to 50% float. I think right now I'm like 56% into it. And I think that is where I will stay for the time being. The total utilization on the portfolio is only 68%. I'm still 96% allocated. So I have money ready to go to things, but it's not time to apply it, at least as far as I see it. So right now in IWM, I still have some short puts that are out, and I still have some short calls that are out. And the short calls, I actually adjusted a bunch of those today. So, well, was it today? Am I lying? It was yesterday. Sorry. I adjusted the short calls yesterday, and I actually took my bases closer. So I had some positions that were at the expiration 22 March. So they still had plenty of time, but I had like the 210s. So there was no reason for me to hold on to those 210s. And I think, yeah, I took them in for 33 cents and I sold them out for 219. So that's the kind of thing that if I didn't feel this way, I probably would have just let that go. But because I feel the way that I do, I took those in for the 33 bucks per contract. And then I offered new stuff now out at 206. And if you remember, my basis now, after unwinding all of the longer term stuff that I had, is like 202. So 202 to 206, it's a small movement. But I have no problem re-entering this position if it starts to move in the direction that I want. As you can tell, I'm not selling right at my basis. There's no reason to do that. But I definitely am trying to keep a good handle on the risk that's out. As we can see over the past 3 months, IWM has generally respected the 50-day moving average. It's used it as support a couple times, and it had no problem popping right back up through it after it fell below, but did close above. So all of this, I'm not like bearish in IWM. My expectation though is that it doesn't have a ton of wind at its back right now, and I wouldn't be surprised to see, especially with this rate conversation going on, this to trend sideways for a bit longer. So yeah. Treasure says, what about tech? Unlike IWM, I continue to remain near 70% utilization. Yeah, I mean, like, so we can pivot over to that next, which is the TQQQ's position, which even that I am paring down. I spent time today culling this position. I started culling it yesterday, and it's because of where it was in these moving averages. And today I absolutely took more off. I'm in profit, but now on the residual basis, I'm not at a great spot because I've taken profits over the past 2 days. My basis right now is 60.46. So we are a bit high compared to where we're currently at. As you could tell, I was scaling into it previously as we were, again, getting like good price accommodation. But for whatever reason, with the recent stall, tech is also flattened out quite a lot. And if we take a look, there's a couple big reasons for this. I think a lot of the semis are slowing down pretty meaningfully. So if we look at just the regular Qs not leveraged, so if we come over here to the standard Qs, there's, Joe says, can't see data at the bottom. Yeah, there's nothing to see down there. So you're okay. Don't worry about it. So looking at the standard Qs, it is now falling below the 20-day moving average, 10 pointed down, 20 pointed down, still aligned properly. We're coming down, actually, believe it or not, to a -2 standard deviation move. Not quite, but almost. And the 50-day MA is starting to catch up with price. Now, a couple things I look for in this case. I want to see if these two moving averages converge a bit more. If they do, it can mean a few different things, obviously contextually dependent, but this is a pretty big gap between these. And for those that don't know, I track the width of MAs pretty regularly, and this is a pretty big gap. So more often than not, you'll see stuff like this start to contract just a bit. I don't love the way that the moving averages are aligned here. This looks very, very much like MA crossover potential, where 10 will fall below the 20. We're very close to that already. If we get anything that resembles like a non-nice open next week, it'll pop right below it, no problem. So then if that's the case, the next main area I'm interested in comes down actually to kind of like the 50-day MA. We see this volume node. It might be a little difficult to see on the screen, but it's right here, kind of at like the 425, 426 handle. So when I look at this, there's a big gap in volume here. There's no structural support. There's nobody transacting really at these prices to any meaningful degree. Whereas if you look at this node here, there's more transactions at this level. So what that tells me is, in general, people are not super interested in transacting here, but we might see some here. The next node is definitely down here after a nice giant gap. So when I see closes below these, especially with some overhead pressure as it is, this starts to lead me to believe that we might fall our way back down to kind of this 425 handle in the Qs. And again, with something like the TQQQ's position, this isn't the direction I want it to go. So this is exactly why I started paring the position down. And all of this leads into the other thing I wanted to talk about tonight, which is that other scan that I was just tinkering with, because as I'm paring down these positions a bit, I need to put money to work. So I'm looking for other opportunities that are more appealing given the way that the market is currently behaving. And as I always say, like it's a trader's job to decide what's happening and then to make decisions about what's happening. So this is essentially me outlining those decisions to you. I'm paring down my core holdings right now, both IWM, TQQQs. When I look at TLT, that's kind of my other core holding as it sits right now. This has been doing nothing for a while, and I have a good basis. So to be honest, like I don't care. This can do whatever it wants. This also behaves it started to go back to how it used to be, where this was serving more as a quote unquote risk off asset. But now with the rate discussion that's going on, this is actually going to get jammed down even more, which for me is actually a buying opportunity. I will keep scooping up bonds as they come down here because that is a very high conviction movement. When we see bonds when we see the rate environment change, bonds will move. I'm quite convicted about that. Nobody knows the future. So as I talk about this stuff, I don't fucking know what's going to happen. And anybody that says otherwise, they're smoking crack. Don't listen to them. But I throw that disclaimer out there because as I talk about this stuff and paint my picture in my mind, it's always tempered with that thought. Like at no point do I actually know what's going to happen. But sometimes as I'm talking about it, people get the other idea. And as people hear people talk about this stuff, sometimes they make decisions that don't make sense. So don't do that. Don't listen to what I say. I'm a dude online talking about what I'm seeing. So there's that. So anyways, I like TLT here as it falls down to this. Again, you can see it transacting all over this. This is going wild. Kind of 93.5 handles. So this is all good. I have no drama in here. Plus my holding in TQQQ or TLT is still, I'm only 81.6% utilized in there. So this is fine. There's nothing that I'm going to do in here. I have the full coverage Strangle on. My basis on the shares is really good. And it's looking like right now for the puts, I have 95 out. So those are definitely in the money. And those expire on 28 March. So really good chance gonna have to do something with those. And then yesterday, I offered, oh, that's actually kind of cool. I literally have a covered straddle out right now, actually, because I'm short the 95 calls as well, but those are out into 12 April. And I offered those for 65 cents and I got into those yesterday. So those are obviously doing okay. And the cool part is with the basis, I mean, I can just transact here all day with the short calls and I have a ton more room to add. I have a decent sized position in here in total. So we have room to play. So yeah, that's TLT. Now going back to Shrey's kind of overall question on tech, and let's take a look at the chat. I know I said a lot. Truck Complaint says, would you consider a short vol position IWM? I technically have that already with the short option, so that's a thing. Charles says, Q's breaking that lower trend line on the daily chart. I think lower we go. It could be. I think the thing for Q's is if you look at how resilient it's been, even if it goes quote unquote lower, depending on how low we want to say it's going to go, it's still on a just outrageous tear. So to see something bump up against a high like this and slow down is just normal. It's like there's nothing about this movement that's concerning to me whatsoever. I fully am still bullish in tech. Whereas in something like small caps, what I can tell you is that if this inflation, let's just play out an alternate scenario. Let's say that we get closer to June and inflation is still high, the Fed doesn't cut rates, they move it out. Small caps are not going to like that at all. Moreover than not liking it, they're in a structurally different position than something like bonds. Because small caps, there are small cap businesses that are trying to survive in a very tough environment for them. It's very different than bonds. Bonds don't have to survive there. Bonds are just reacting to where prices are going. So a bond position, if rates stay where they're at for longer, yeah, you're not going to see bond prices skyrocket, but it doesn't mean that they're going to plummet either. Whereas something like smalls, they absolutely can start to see some downside velocity if we stay at a high interest rate for too long. That's also why a sneaky suspicion I have is that we might do a cut pause, and then that starts to impact the Fed's messaging about its capacity to do 3 to 4 cuts this year. You start to run out of time. So originally the Fed was messaging a pretty aggressive rate cut regimen, and that looks like it could be changing, especially if this ball keeps moving in that direction. So while we're still seeing the majority probability of a cut in June, it's now not by a landslide. It's barely so. But as I look back again to tech, it's fine. It's doing absolutely fine. So even if it comes down a little bit, like realistic, the only reason why I'm considering like impairing down the position and considering doing that more is because I'm in TQQQs. This is a daily leveraged product. If I was in something like Qs, I wouldn't care at all. It would make no difference to me. So, but something like TQQQs, if you stay in these down moves for too long, you need continued sustained up moves in order to overcome it. So you'll notice as I talk about trading the coverage triangle on something like IWM, I can be way more passive, whereas something like TQQQs, I have to be way more active. Otherwise, I put myself in a rougher scenario to make good money. And also, to be clear, I think I could just hold TQQQs and be fine, especially over the course of a year. But that's not my job as a trader. It's not just be fine. It's to try to create a certain return profile. So there's no real incentive for me to just hold this blindly, as it might start to come down, especially as it's approaching the 50-day moving average, those kinds of things. This is a normal pullback to me. But what I'll do is as this starts to drop off, I'll wait until it starts to consolidate again, and then we'll see if it resumes a strong uptrend. And then if so, it's just time to re-enter. It's a pretty simple formula for me when it comes to the TQQQ position. But that's what we're looking at there. Okay. So now the other thing I wanted to talk about for a few minutes is kind of this scan that you guys saw when I first popped in. And there's a couple things that I've been tinkering with. Right now, I'm in the process of conducting another analysis that's looking at the efficacy over time of different valuation metrics. So things like price to book, price to sales, relative strength, PE ratios, return on equity, even current and quick ratios. And I'm noticing a few pretty dominant trends in this whole thing. It's actually pretty straightforward, where in longer term time frames, things that are bought at a reasonable price tend to outperform with lower volatility. It's almost like that dude Warren Buffett knows what he's talking about. Kind of fucking weird, isn't it? But the more important thing here, though, is that even from a momentum perspective, especially as I layer on things such as relative strength, and this isn't relative strength against a benchmark. This is relative strength against itself over the course and the leading performers in terms of percentage returns over the past year. So because of that, it offers another opportunity, not just for kind of Warren Buffett style trading where it's longer term. I'm just opening these up a little bit so you can see more of what I'm looking at. It's not just Warren Buffett style trading where you get to see just, buying and holding stuff and then coming back later, but it applies also in momentum style strategies. So that's what I'm looking to do. So as you can see, part of this scan here is I'm looking at optionable stuff with weeklies. You don't need to have weeklies. I like them, but you can see how much weeklies changes the universe. It takes us literally from 140 down to, what was it, like 18? 18. So this is just a liquidity measure, and I do typically prefer weeklies. So that's one of the things I'm looking at. Now, the other metrics you see here, we have a PE ratio of up to 35. This is high. According to most of what I'm seeing now, and I'm looking over the past 65 years, 20 is what really you want. Now, obviously, we don't want negative PE ratios. We don't want stuff that's losing money. And to be clear, the premise for this trade is a diagonal call. So this is bullish in its nature. There are different versions that I have maybe a little bit less strict and also allow me to trade to the downside. I just wanted to be clear. This is looking for ratio calls. So PE ratio needs to be definitely positive. Price to book ratio, same thing. We don't want negative stuff here. This really needs to be a positive figure. But what I found is less than 1 is actually typically what we want. But because valuations are kind of crazy, you have to tinker with this number a little bit in order to get a big enough tradable universe. So like, for example, if you look at 1, there's 2 matches. If I look at 2, there's 93 matches at that point. So you can try to look at something like 1.5 to break that down just a little bit. But same thing, sales per share, again, same story. This needs to be a positive integer because it's sales, it can't be negative anyways. And sales per share is slightly different. This actually isn't quite as important. Really, what you want is, at least based on the study I'm doing, is a price to sales ratio. So sales per share is good. Charles says, throw up free cash flow versus cash flow. It's funny you say that. I literally used to have free cash flow, and I took it down because it doesn't actually matter if it's free cash or cash. Now, again, it depends on the objective for the scan. For my purposes, getting to the more nuanced versions between even like quick versus current ratios, it doesn't actually matter. It doesn't move the needle that much. And one of the things you'll find specifically for something like you, Charles, where you're saying like use free cash flow versus cash, is I actually used to feel the same exact way. It's why I had it here. I used to have them right next to one another. But as I'm taking the time to actually quantify what I'm looking at, and I'll throw it in there just to a comparison. I'm happy to put that in. Here we go. And we want cash flow per share next to sales per share. Okay. You guys should see it in there now. It's probably a little squished. Yeah, it's buried. Give me one sec. I just want you to be able to see the comparison. But there's a couple reasons why this actually doesn't matter that much to me. I think we can go this way. So for those that don't know, there is a difference between free cash flow per share versus cash flow. And there's also another version that you can throw in where we look at something like operating cash flow. But when you use free cash flow, it's a little bit more of an assessment of how efficient the company is. So that looks at things like operations and investments that the company is making, and it takes those out before it gives you whatever the cash flow is. The reason why I don't think it matters that much is multiple fold. The first reason is because those can be modulated quite a bit. Cost cutting is a thing, as is investing, whatever those activities are, those can be modulated quite a bit. So it doesn't actually matter quite that much, in my opinion. But again, to Charles' point, it's okay to look at it. You're not going to break anything. Just from my experience now starting to quantify these different metrics, it doesn't really matter that much. But anyways, what does matter is essentially the valuation multiple in some degree. So what I'm looking for here, again, stuff that's trading at a reasonable price. The most important part of this scan is this here. Things that are near highs. Charles says, generally negative free cash flow companies don't really go up, I found, in share price. To a degree. So like, if you look at GM has negative free cash flow, but crazy good cash flow. If we take a look at its price performance, I would say it's gone up like pretty meaningfully, especially from this low that it hit down here towards the end of last year. It's almost doubled in price. So again, that's why you have to be careful with one, what your trading objective is, and then two, what we're actually seeing. Because again, like I've tested it quite a bit and I'm not sure that that's quite accurate. Now, again, what I would say for sure is that if you have something that has negative cash flow and negative free cash flow, that's a problem. Negative cash flow is like, it's caustic, but free cash flow, I think there's a little more wiggle room there. Again, you got to do whatever's right for you, but I've seen that's just an instance right here. I think that the main feature is cash flow. Anyways, so we want stuff that's at a decent price, and this is the most important. We want stuff that is near-term highs. So this is a scan that I'm running, and I'm starting to find what's working. A couple things that I'm overlaying here, you guys have seen me do this before, where I'm looking at 1 month, because right now my thesis is shorter term stuff. I'm not looking for stuff that I'm going to hold for 3 to 6 months. I'm looking for stuff that I might hold up to 3 months, if that, probably a month. So as I look at 1 month, I see these top 3 performers: materials, energy, staples, come into 5 days. Materials, staples falls a little bit, but energy up at the top too. So energy and materials continually pop up, at least in near term strength measures for me. So if this runs, maybe, let's just try to change this real quick. So as I look at this, I wonder if I can get rid of this and it still runs. I'm just curious, like, what the hiccup there was. Whatever. So as I look at this, there's a bunch of stuff actually in financials that are still showing up pretty strong. The other sectors, though, that I told you that I want to look at are things like energy and materials. So if I look at SWN is moving well. It's a little too small for me to trade, but it's something that I would watch, maybe even for a small exposure. So you can see kind of this short-term chart over here. LeBark says, dumb question, does TOS have the ability to fill out sectors? Yeah, definitely. You can choose stuff up here if you're so inclined. You can add it as an actual filter here if you're so inclined. I'm not relegating myself to that. You'll notice the way that I typically like to scan is by keeping as many things open as I can and then narrowing it down over time from there based on, what I'm looking to see. Like, so for example, when I looked at Citigroup C, I actually really like this chart. Like, I think this thing's on a tear and it's crushing it. So even though I'm not seeing financials killing it right now, if I go out here to a month, financials is like middle of the pack, not doing a whole lot. But you have to remember, like, just because something is in the middle of the pack in terms of sectors, it doesn't mean that it's not flying off the handle in the subsectors. Now, again, we want to stack strength. So I wouldn't take this to an extreme where if I'm trading financials and it was negative, I probably wouldn't do that. There's just not a compelling reason to do so. But otherwise, when I look at something like Citi, it actually looks like pretty attractive here, especially as it's starting to trend sideways. This is the kind of thing that I would absolutely consider entering via something like short puts. And then depending on how it behaves, you can either start scaling in via coverage triangle if it starts running back up, or you could even convert it into a ratio diagonal, which is probably more in line with what I probably am looking to do right now. So going back to the scan anyways, I see T, which doesn't look interesting. This is a 6-month daily. Let me change this one so that it's a 3-month daily for you guys. Just so you know, when I'm looking up there, I'm looking at charts on my upper screen. But I want you guys to see more kind of what I'm focusing on. So this, I'm going to change it to a 3-month daily. And it's really compressed because it has earnings coming up. But on a 3-month daily, wow, that's actually, I want to show you guys this. Look how different that looks from this to this because of the compression, because of this earnings. This makes it look way more parabolic up than it is. I don't hate T here. Like, this would be another long candidate for me. But what I'm looking for is to see if there's anything in those specific sectors that are really doing well. So again, consumer staples, material, energy. So energy, we have something like BTU. BTU is getting killed right now to the downside. So this is no good. Bud going down. This is no good. SWN, this looks okay. But again, a little cheap. That could be annoying. DLF, I don't hate. It's below the 50-day moving average. So that I would have to monitor, though. That wouldn't be like a yes, please kind of thing. This is, I need to make it easier to see if it's staples or discretionary. So let me squish some of these up real quick. What I'm trying to do is see if it's staples or discretionary. A little easier as compared to having to zoom time. It's easier for me to find what I want. Energy, we got 2 more here. So CVX. DVX is interesting. It looks really bad on a 1 year daily, but on a 3 month, it doesn't look bad. 6 month, it looks bad too. I don't love that either. 3 month, it looks okay. So this is an example of I wouldn't force this. So this is something that is struggling here. This is actually something I will tie an alert to on this. And I'll tie an alert below here, where if I see a cross below this, this actually starts to become a short candidate. So we'll throw that in, and then on the alert above, it becomes something to watch if it channels sideways a bit more. All right, down BP, bad on the year, okay on a 3 month. Again, and this is what you're gonna see for energy, because energy has been doing terribly for the majority of the time. If we break this out again real fast, you'll see exactly what I'm talking about here. If we go to the 3 month, energy starts to fall to the middle of the pack. And then if we go to 6 months, energy is like at the bottom. So energy is in the process of going through a bit of capitulation here. Now, whether that means that they gain strength and maintain it, but that's why on so many of these charts, you're actually seeing something like energy doing well in these shorter term timeframes, but on the longer term timeframes, it's struggling a bit. So again, this is why it's really important to define the duration of your thesis, because on a short-term thesis, this is starting to turn around pretty massively. So it's something that I pay attention to. So anyways, this is a rundown of just this kind of strength scan that I'm trying to deploy now based on that new data that I found, and we'll see how it goes. It's something that I'll add a bunch of these to watch lists. I'll paper trade a bunch of them. I'm going to add a bunch of alerts to the chart so that I can see what is doing where and when. But there are actually quite a few things right now in energy that are making a pretty massive turnaround in these short-term timeframes. I actually would even wager I'm quite late to the party here. I have some energy names that I've entered into previously from a couple other scans, but nothing to size. And it's because energy has been struggling so much. But something even like KMI, this looks terrible. This is not something that would be added on at all. And I actually don't see many consumer staples in here at all either. Staples is not doing great. So, but we're also intersecting against weeklies. If we open this up outside of weeklies, we'll see a lot more going on there. But anyways, that's a quick run through of both covered Strangle and IWM TQQQ's recent scan that I'm trying to do, looking for strength. It's time for me to hop off. Got to hop in the hot tub and the cold tub for a little bit, enjoy a little pain and suffering. I hope you guys enjoy your weekend. Be an outlier.